Hello students, now let's start with the last module of this lecture. In this lecture, we are focusing on the practical applicability of this MPT theory and the relevance of MPT in present scenario. So, when we are talking about the practical application, how in real life scenario the fund managers or the normal investors can use this MPT or the modern portfolio theory to develop their portfolio in a better manner. So, the first strategy that has been used by the investors or fund managers, or we can say the financial advisors for their client, is basically asset allocation strategy. When you talk about the asset allocation strategy, is basically focus on what are the different types of asset classes that are available to a particular investor for investment and how he going to include that in the portfolio depending upon his or her risk tolerance. So, if we talk about a particular investor who is risk aversive, he can increase the component of fixed securities in his portfolio, and if he is a risk taker investor, he can increase the amount of risky instrument in his portfolio. So, it depends upon how he going to select the different asset classes and develop his particular portfolio. So, in this particular concept, we are talking about the different portfolios that has been developed with the use of asset classes. So, asset allocation is a process of dividing investment among different asset categories that I have already mentioned. In our previous lecture, we already discussed about the different asset classes. We can divide it into stocks, bond, real estate, cash, or depending upon the investor requirement, he can go for bullion and artifacts. It up to the investor how he going to identify the asset classes that where he needs to invest this money. So, MPT emphasizes that the way assets are allocated can significantly impact the overall risk and return of the portfolio. In our second lecture, we have gone through this particular concept, and similarly when we have explained the concept of optimum portfolio and two fund separation theory, we are already gone through the concept of risk-free instrument, and if we include the risk instrument, how the optimum portfolio or tendency line changes. So, this way we know how MPT helps in asset allocation properly to an investor. So, for example, if a particular investor is approaching for balanced portfolio approach, or the financial advisors think that his portfolio client is, or the client is basically a risk neutral person or risk moderate person, he can develop a portfolio accordingly. So, in this example, a financial advisor may recommend a portfolio composed of 60% stocks and 40% bonds for a moderate risk taker, or we can say a neutral risk taker. This allocation balances the growth potential of the stock with stability of bonds, because neutral persons are those who try to minimize their risk with the help of diversification. He is more balanced in his portfolio strategy. So, he is adopting this balanced approach. So, if with the help of this balanced approach, that means 60% stocks and 40% bonds, he can have a balanced portfolio, and during the adverse situation, like in this example it is mentioned that as COVID downturn comes, the bonds are going to provide a cushion to the portfolio, and when the market rebounds or when the market reversal take place, in that scenario the stock is going to give benefit to the investor. So, if a particular investor is a moderate risk taker, he can go for a balanced approach. So, now there are certain strategies, or we can say the allocation strategies, that can be adopted by an investor or financial advisor or fund managers for their portfolio. So, first one is strategic asset allocation. So, a strategic allocation is a long-term investment strategy that sets target allocation for various asset classes based on investors' risk tolerance. Most important aspect when you talk about diversification or asset allocation or selection of asset, we need to understand that we need to identify the basic quality of an investor, whether he is a risk taker, risk neutral, or risk moderate or risk aversive person. So, if we understand that his risk tolerance is very low, we are going to provide the assets according to that. If a person is a risk taker, we are going to provide or advise the investor accordingly. So, we first need to understand the risk type of an investor. So, in this example, a young investor with a high risk tolerance may set a strategic allocation of 80% equity and 20% bonds. Very good portfolio, whereas because he is a risk taker and he is a young age person. We already know the age is a major factor when we form a particular portfolio. So, this young person is a risk taker and he invested 80% of his money in equity and 20% in bond. Over the time, his allocation may be adjusted as the investor ages and his risk tolerance decreases. So at initial age, if we take up to 35, he can choose high risky instrument. But as he ages between 40 to 45, he is going to take moderate risk, and later after 45 he is going to take less risk, and his instrument should be like that. The portfolio in the strategic allocation scenario, what we need to see? We need to see the age of the investor. If he is a young investor, in that case his risk tolerance is high, he is going to invest more in equity, and as he ages his portfolio automatically changes. Now second one is tactical asset allocation. This is a short term strategy that has been adopted by the investor. It allows investors to adjust their mix based on the market condition while maintaining a long-term allocation. So in this particular example, an investor may increase his allocation to stocks during a bullish market and reduce it during the bearish market. So what he is going to do, if the market scenario is bullish, he is going to invest more in equity because it is going to give him more returns, and as the scenario changes, he take out the money from the bearish market condition and put it into bonds where he is going to get a secured return. So tactical asset allocation strategy work along with the long-term strategy. Next one is dynamic asset allocation. This strategy involves continuous adjusting the asset mix in response to the market condition. In tactical, we are focusing on short-term strategy, but in case of dynamic asset allocation, we are focusing on the market condition and continuously we are changing our portfolio. For example, an investment manager may increase exposure to bonds during periods of market volatility to reduce overall portfolio risk. So he can directly invest in bonds when the market scenario is quite bullish and highly volatile, and then shift back to equities as the market stabilizes. So this is continuous a dynamic process. Sometimes investors also follow this particular strategy, and mainly it is followed by the fund managers or investment managers. Now what are the factors that affect the asset allocation strategy? The first factor is risk tolerance. We already know that the major asset allocation is done on the, or majority of asset allocation is done on the basis of risk tolerance of the investor. If we can easily identify what is the risk capacity or risk appetite of the investor, we can allocate or form a portfolio according to his requirement. So individual risk preferences play a crucial role in determining asset allocation. Higher risk tolerance allows for more equity exposure, while lower risk tolerance favors bonds and cash. So if a retiree may prefer a conservative allocation because he is already retired, he don't have any source of additional income, he only have his retirement fund along with him. So what he is going to do? He is going to invest only 30%. It again varies from person to person, but majority of cases are that they invest up to 30% of money in stock because the chances of losing money is higher in case of equity or stocks, and 70% in bonds. So in a way he is safeguarding his fund as well as he is earning some returns from the market to preserve the capital, whereas millennial mind means a young age people have more aggressive allocation up to 90% in stock and 10% in bond or debt instrument. So it depends upon the person's risk tolerance as well as his age and requirement how he is going to allocate the fund. Then coming to investment time horizon, the length of time an investor plans to hold their investment before needing to access the funds influence the asset allocation. After a period of time, every investor or every individual persons require the fund. So for how much time we are locking the fund, that is also important to know. If the person is at a young age and is a married person, he needs a certain amount of money to purchase his house or for higher education of his children or medical health care of his parents. So depending upon his requirements, he is already investing. But for how much time is locking the money, that is also important concern for the financial advisor to know, and why he is investing the money, that is also important to know. So in this example, a student saving for a tuition payment in 3 years may have more conservative allocation of 50% bonds and 50% cash, because what he is doing is saving the money to pay the education fees, compared to someone investing for retirement in 30 years. So he is having 80% in stocks and 20% in bond, because he has a time period which is longer as compared to the student. A student required funds for higher education. He may be in 8th class or 9th class. He is saving for the money. So the time period is very limited to him. So you cannot use the money in that way that the other person is using. So in this particular example, we can say a college student is saving the money for his further tuition fee. So he requires his investment criteria as 50% bond and 50% equity. While the person who is saving for his retirement and he has a young age, so he have more than 30 years left with him for retiring. So he is saving a maximum portion in equity and less portion in bonds so that he can earn a lump sum amount at the time of retirement. Next condition is market condition and economic indicators. So investors may adjust their allocations based on macroeconomic trends, interest rates and market valuation. So for example, during a period of rising interest rate, investors may reduce their exposure to long-term bonds due to potential for capital losses and increase their holding in equity. Because when the interest rate are rising, at a point of time it is going to give benefit in shorter period, but in longer period it may happen that it get reversed, and in that scenario the investor may lose money. So it is better to invest in equity when interest rates are rising in case of bonds, not in case of banking instruments. Now coming to asset allocation models, what are the different models that has been approved by the investors, or we can say the portfolio advisors? That is 60-40 portfolio, or that is a balanced approach we have already gone through. Here what we need to do, we need to invest for 60% in equity and 40% in bonds. This model aims to balance growth income and risk management both. So 60-40 portfolio has traditionally provided a good balance of risk and return over a long period of time. Through market conditions may lead to adjustment. Depending upon the market scenario, some provision of adjustments are required. So it depends upon the market condition, the investor can adjust the portfolio. Then aggressive growth portfolio, an allocation that consists of 90% equities and 10% bonds, typically suited for young investors or investors who are interested in taking high risk. So their risk tolerance is high. This portfolio might invest heavily in tech stocks, emerging markets and small cap growth stocks, focusing on maximizing returns during the bullish market period. So we need to understand if a particular person goes for aggressive portfolio, what are the basic stocks or basic sectors where he need to invest so that he can get much out of it. Then comes the conservative income portfolio, composed of 30% equity and 70% fixed income. This strategy is ideal for risk-averse investors because we are investing only 30% in equity. So the amount of or the proportion of equity investment is less. That's why it's a conservative investment strategies. It is also good for retirees who are looking for steady income, because now at the time of retirement they required a fund that should give them much benefit or standard of living as per when they are earning the money. So when they are a salaried person, whatever the standard of living is of that person is, they should maintain that particular standard of living, and that's why they are investing more in bonds so that they can get good amount of interest from the investment. This portfolio may focus on dividend paying stocks and high quality bonds to provide regular income while preserving their capital. So I think in both the cases, aggressive and conservative, you are able to understand what type of stocks a particular person is selecting. In case of aggressive, they are taking tech stocks, small caps, growth funds. But in case of conservative, we are focusing on high quality bonds as well as dividend paying stocks. That means companies who are quite matured enough and they are paying regular dividends to the investor. So we need to bifurcate the requirement according to the risk tolerance and the age of the investor. Then next question is rebalancing the portfolio. Every time when you go through these particular portfolios or go through this particular scenario, we need to rebalance it according to the market condition that is prevailing at that point of time. Whatever is the allocation strategy, whatever the strategy particular or whatever the model the particular investor is following, he need to rebalance the portfolio on time to time basis. So rebalancing involves adjusting the asset mix back to the original allocation as market movement causes deviation from the target percentages. For example, if strategic allocation is set at 70% stock and 30% bond, and due to strong stock market, the allocation shift to 80% stock and 20% bond, we again need to rebalance it and adjust it accordingly. So the benefit of rebalancing it is that it helps maintain the desired risk level, prevents the overexposure to particular asset class. In this example, we can see that his total amount is 70% and 30%, but it shifted to 80% and 20%. So he is rebalancing so that he can maintain the situation easily. Now next is the risk management in portfolio construction. So risk management involves identifying, assessing, prioritizing risk, followed by coordinated efforts to minimize, monitor and control the probability or impact of adverse events on the portfolio. So we need to understand the concept of risk management is very important for an investor as well as a fund managers, or we can say the portfolio managers, because they need to understand what is the basic scenario that is going on and how to mitigate or control the portfolio so that we can nullify the effect of risk that is involved in investment. So effective risk management is crucial for protecting capital and achieving the investment objectives. MPT provides a systematic approach to understand this particular concept with the help of diversification and proper asset allocation strategies. Now, what is a diversification strategy that has been adopted by investor? It involves spreading investment across various asset classes that we already understood, or sectors or geographical regions to reduce the exposure to a single asset or risk. So, what can be the example? For example, in this particular case, an investor has 40% equities. It comprised of large cap, mid cap and small cap companies, not investing 40% total in small cap. We can again diversify this particular equity into different sectors, into different geographies also, or we can take different stocks. Then 40% in equity in developed market and emerging market. Again, we are diversifying the exposure effect. 30% in bonds, that is again divided into government, municipal and corporate bonds. Not a single bond is taken. And 10% in alternate investments like real estate and commodity derivatives. So this diversification approach can help mitigate the impact of poor performance in a single asset class. If an individual take a single asset or a single particular diversification is followed, in that case that will not be good idea. This particular diversification strategy is helping the investor to mitigate the risk. Now, rebalancing as a risk management tool. Rebalancing, we have gone through how to rebalance the portfolio. For example, target allocation strategy has been adopted. What he can do if the portfolio is designed for 60% stocks and 40% bond, due to again certain stock market rally, if the portfolio changes to 70% stock and 30% bond, the investor can again rebalance it to the original position. So it is going to give benefit to the individual investor as well as a fund manager, so that they can lessen the exposure of risk and mitigate the risk at the same time. Now coming to investment policy statements for institutions. There are certain institutions who have their certain policies that they have to adopt, that this much percentage should be invested in bond, this much in government bonds, or this much in equity. So certain policy documents are there for every case, whether it in India or in other country. So policy documents are already given by government how the fund managers or investment managers should decide upon the portfolios. So institutional investors such as pension funds, endowments and insurance companies often develop investment policy statements based on MPT principles. And IPS outlines the investment strategy, asset allocation and risk tolerance for the institution. So a pension fund might decide to allocate 50% to equity, 30% to fixed income and 20% to alternative investment based upon the MPT analysis. Now what is the scenario? The fund regularly reviews its allocation based on market condition and rebalances as needed to maintain the desired risk and return. So this is the basic condition which is adopted by different institutional investors to mitigate their risk. Now finally, the evaluating fund performance. How we going to evaluate? I think you are going to go through the different Sharpe ratio or Trainer ratio through which you are going to understand how the performance evaluation of individual funds or a particular portfolio takes place. So in this particular concept, we are just focusing on, we need to use Sharpe ratio to evaluate the portfolio time to time, and if the portfolio is not performing well, in that case we can again go and reevaluate it, again review it, and then again form up another portfolio which is going to give expected return, and then again we have to test the portfolio. In the same procedure, the whole process will go on. Now, there are certain performance indicators that can be adopted by an investor as well as a fund manager. The first one is benchmarking the fund performance. How are we going to do this? Comparing a fund performance such as relevant benchmarks such as an index to gauge its effectiveness. For example, a large cap equity fund might be compared against S&P 500 index. If the index returned 15% in a year while the S&P provided 10% return, the fund is performing well relative to its benchmark. Now, in comparison against the peer, so here we are comparing a fund against a particular benchmark index. In this particular comparison with peers, we are assessing a fund's performance relative to similar funds that are available. Suppose we take the case of mutual fund. So, if we are talking about the equity based mutual fund, we have taken HDFC's equity based mutual fund, ICICI's mutual fund, and then we are going to compare it. So, equity mutual fund that consistently outperforms its category average, for example, large cap growth funds, by significant margin may indicate a superior management or investment strategy that has been adopted by the fund managers. Then now coming to the practical implications of performance evaluation. So, how are we going to evaluate a particular fund, or what is the performance evaluation of particular fund? What is the practical implication of that? So, investment decision, investor can use performance metrics to decide whether they go for buy, hold or sell a particular fund. So, sometimes we go through, suppose a security site like ICICI Securities, we can easily say check whether the fund is telling us to buy it, hold it or sell it. Suppose you are interested in purchasing a mutual fund, you can go through this particular site, you will be able to analyze that they have given certain directions to the investor, that they can go for buy the instrument or sell the instrument or hold the instrument. So, with the help of Sharpe ratio or Trainer ratio, we can easily evaluate the performance and compare it with the benchmark index or compare it among the peer group, and then on the basis of that we can decide whether to sell the stock or buy the fund. Then managers evaluation, we can easily evaluate the performance of the fund manager on the basis of the performance of that particular mutual fund or fund, because if the mutual fund is not performing well as compared to other mutual funds of different company, in that case we can easily evaluate the fund manager is not doing a proper job, his market timing is not proper and is not selecting proper stocks for his investment. Now, reallocation of assets, investor may choose to reallocate funds to better performing investment based upon the performance evaluation. If a particular mutual fund is not performing well, in that case he can go for selling that particular fund and go for purchasing another. Similarly, if he has a particular portfolio which comprises of certain stocks and certain bonds or certain other instruments, and that particular portfolio is not working well, is not up to his expectation, his performance is not good, in that case he can sell some of the stocks or some of the bonds out of it and go for purchasing new stocks and new bonds, and that should give him better returns in coming future. Now, what is the relevance of this particular theory? Sometimes we go through this theory and say that this particular theory is not relevant in present scenario. But this particular theory is the age-old theory. It established in 1950s, but still it is useful for the fund managers and investors. If the investor know how to utilize this particular theory, then they can get better returns out of it. Otherwise, it is a most prominent theory that has been used by the fund managers. So, what is relevant? It is a foundation of investment strategy. Whatever investment strategy we have looked into, or we will go through different asset pricing theories, the MPT theory is a base theory. On the basis of this, whole diversification has been developed, or we can say the concept of diversification has been developed and utilized by the fund managers as well as the investors. So, without this particular theory, we cannot know how to diversify the portfolio. Again, the adapting to the market volatility, this particular concept is, if it is known to investor, they can change the asset allocation based upon the market scenario. So, we can say the MPT provides a framework for understanding how to allocate assets in volatile market, helping investors maintain a balanced portfolio. By using MPT principles, investors rebalance portfolio, shifting allocation to defensive sector and fixed assets to mitigate risk at a time of volatility. So if we are known to this particular concept, we known to the particular concept of diversification, then only we can use this particular theory properly. Otherwise, it becomes difficult for investor to diversify their portfolio at the time of volatility. Then emphasis on diversification in MPT model, it is clear-cut concept of diversification. We can say that it propounded the concept of diversification in such a beautiful manner that investors knows how to diversify the portfolio. Initially, before this particular concept, people or investors know how to diversify, or maybe they don't know about the concept properly. So there are two scenarios, whether they know about the concept properly or whether they go for the diversification. Initially, the people are focusing on single stock diversification. That means either they are investing in railway stocks or a particular company stock. But after the concept that has been popularized by Henry Markowitz, investors are focusing, or the fund managers are focusing on diversifying the portfolio using different diversification strategies. So it becomes easy to diversify and mitigate the losses. Then understanding investors' behavior, with the help of this particular concept of diversification, we can understand the risk tolerance level of investor, and at the same time we can understand the behavioral pattern of the investor, whether they are loss aversive in nature or they are overconfident investor, and the financial advisors can advise them accordingly. Similarly, some financial advisors as well as fund managers also go through certain biases. So if they analyze their personal biases, they can also form a portfolio accordingly. Then use of technology. MPT also helps in use of different technologies, because in real life situation, normal investors cannot calculate or form portfolio on the basis of the formulas that we have studied. So we need high tech technologies as well as new technologies like machine learning or robo advisors, also helping portfolio diversification and helping fund managers in better allocation of funds. Evolving investment trends. MPT can be adapted to incorporate ESG guidelines for the portfolio constructions. If the investors are interested in having a portfolio that is related to sustainable finance or impact investing or ESG concern, in that case, fund managers can form the portfolio based upon these particular upcoming concepts also. Educational framework for investors. MPT serves as an educational tool for investors, helping them to grasp fundamental concept of risk and return, correlation and covariances, and help them in better asset allocation. And finally, adapting to changing economic conditions. MPT's emphasis on assessing risk and return can be adjusted to changing economic scenarios such as inflation, recession, deflation, etc. So according to the market scenario or market condition, the portfolios can be rearranged or rebalanced according to the situation. And finally, we can say there are a lot many criticism of MPT theory. Despite the criticism, the MPT or the Markowitz portfolio theory is the most prominent theory that has been adopted by fund managers for better asset allocation and better portfolio management. With this, we come to end of this particular topic. Thank you.